Hi folks, it's Steve here at the Forex Codes. Good afternoon. I'm into my 16th year of trading, and honestly I've made every mistake in the book, but I'm still standing and I'm still profitable. Ignore the following gems at your peril. Now don't worry, because every trader, and I mean every trader, falls foul of these, or one or two, or all of these 25 rules, gems if you like, at some time, and usually to his or her cost. Sometimes you can get away with it, but most of the times you can't. But if you keep a trading log, and I'll show you the trading log later in the presentation, if you keep a trading log of all your trades, you'll quickly pinpoint which of these rules you've broken. This is important to succeed as a trader. You've got to have a record. Okay, gem number one, protect and preserve your capital. Because if you lose your capital, you're out of the game. You've only got so much money to play with, and I say play very loosely. You've only got so much money to invest. And if you throw it away, you're out of the game. Novice traders, beginning traders, enter the markets focused on how much money they stand to win. They look at a trade and say, yeah, if it hits my target, I'm going to win $100. Professional traders, however, they enter the markets, they enter a trade focused on how much they stand to lose. Note the difference. They look at professional traders looking at protection of capital, not on how much they're going to win. Always use a stop loss. Always. And I don't mean a mental stop loss either. Put a stop loss into your trading. Money management is the key, and we'll cover that in later videos. Stay tuned. But you've got to manage the money, you've got to manage the risk, and you've got to protect and preserve your capital. Gem number two. I love this. Trade what you see, or not what you think. Egos and trading don't mix. Release the need to be right. If you're one of these people who like to be right all the time and can't stand being wrong, forget trading. You'll get obliterated. The markets are always right. So that's the first thing. Use your charts, technical analysis, to tell you what's happening. Not the little voice in your head. You know that voice that says, I've got a signal here saying long, but come on, I just know it's going to fall. Those who've been trading for a while know what I'm talking about when I say, I just know it's going to fall, or I just know it's going to rise. Ignore the little voice in your head. With experience, it disappears. Use your charts to tell you what's happening. And this is a saying by myself, and if you Google it, you'll see it's accredited to me. The markets don't care about me. The markets don't care about you. The markets do what the markets do. Absolute truth. Okay, number three, keep a trading log. This is absolutely prime importance. This should include the reasons why you took every trade and what happened. In other words, why did you get into the trade? What happened during the trade? How did you get out of the trade? In other words, how did you manage the trade? Mention if you broke any rules. Because you're working to a trading plan, or you should be, or you will be when you finish watching all my videos. Did you break any rules? If so, don't do it again. Log the time, the date, the profit and the loss. Take a picture. If you've got chance, take a picture and question every trade. If the trade's moving too fast, take the picture at the end. If you're in a slower trade, take the picture when you take the trade. You can do that straight from MetaTrader 4. Question every trade. Why did I take this trade? And finally, on keeping a trading log, when you write your log, you realise more clearly what went right or wrong. If you're not keeping a log of your trades, how do you know what went right or wrong the day after or the day after that? With a trading log, you've got a written record. And if you take pictures, you've got a written visual record. Here's an example of a trading log. It's not fantastically clear, but this is on an Excel spreadsheet, so these numbers change as the number of trades increase. You got the date, the entry time, the currency pair, and so on. Entry, direction, target, stop, and it'll work out from these numbers the number of pips and the profit. Why did I enter? There was a squeeze. I reached my target. That's why I exit. And I followed the system. What did I learn? So if you didn't follow the system, or you made an impulse trade, or whatever it was, log everything down in the trading log. Take a picture, and then you got the accumulations on the top. So that works pretty well, and it's on Microsoft Excel. Just ask me for it. Gem number 4, keep your discipline. Abide by your trading rules and your trading plan. You won't believe how many people don't have a trading plan. So how the hell do they expect to make money? So I'm talking about the self-discipline to follow your trading plan without hesitation. And the problems occur when we deviate from the trading plan because of fear, greed, anger, impatience, and any of the other emotions involved with trading. Good self-discipline means you'll follow your trading rules and execute each setup as per those rules without question. Okay? And that takes practice. If you keep breaking the rules, ask yourself this: are you suited to trading before you lose all your money? In other words, ask yourself that question. Because if you don't, you will lose your money. You've got the power to give yourself money or give your money to other traders. That's in your control. With high probability trading, that's within your control. Two main ingredients to successful trading as far as discipline is concerned. One is knowing what to do, and the other is actually doing it. This is number 5, follow your risk and money management rules. Now, in your trading plan, these rules will exist and they've got to be followed. In particular, never trade more than 3% of your capital on any one trade. I mean, that is an absolute maximum, ideally a lot less. I mean, professional traders trade a lot less than 1% on any trade. So that puts it into perspective. Know where you will exit before you enter the trade. Now, any fair-minded person would say that, well, yeah, that's quite logical. But 90% of traders don't do that. It's just a fact. Once you're in the trade and you've got your exit, let's say your exit is 15 pips long from the entry point. Let the trade play out. It either hits your target or it hits your stop. So if you're in the trade and it's 8 pips in profit and you're saying, oh, I've got to take this 8 pips, I've got to take this 8 pips. You know, I was like that for a long time. You do nothing. You sit in your hands until you hit your target or you hit your stop. Gem number 6, accept the fact that you're going to make some losing trades. Accept it, and you're more than halfway there. And I look at it this way as a businessman for many years. I treat losses as a business expense, just the same as an overhead. You know, when I had that kind of business, I had overheads as rent and heat and light, accountancy, legal, and so on and so forth. And I look at a losing trade as business expense. You get them. And I also realise that Forex trading, any kind of trading, is a game of probabilities. And you cannot be right 100% of the time. Professional traders know this and accept it. In fact, some professional traders can be right 50% of the time and be very profitable. It's how you deal with failed trades that will determine your success or otherwise as a trader. Are you going to freak out? Are you going to get angry? Are you going to say, oh, this trade's failed, I'm now going to go for the Holy Grail, the new shiny thing, and look for a different system? Are you going to say, oh, trading's not for me, it's crap, you've got to know, you've got to be insider, and so on and so forth? How will you deal with failed trades? Say after me 100 times, losses do not diminish me as a person. A losing trade is an automatic function of my trading strategy. And that's an absolute fact. A losing trade is an automatic function of any trading strategy. It's par for the course. It doesn't mean you're a bad person, that you're unsuccessful, that you're not worthy. All it means is, in the scheme of things, you've had a losing trade. Wow. Now, accepting this inevitability of a loss is a trading skill, just like recognizing chart patterns, just like recognizing trends. Pros have this skill. A trading skill is accepting the inevitability of a loss. So please look at this and look at this page and review it when you're looking at this video again. Have the discipline to do so. Gem number 7, stop trading after 3 losses in a row. This is good advice as a beginner. It's good advice anytime, to be honest, but if you get 3 in a row, something's wrong that day, isn't it? You know? So call it a day. Go and do something else. Clear your head. Go for a walk. Go in the gym. Because the mind can play games with itself following losses. The urge to get the money back or gain revenge is extreme. I used to do this when I first started trading. Oh my God. So I've had 3 or 4 losses. Then I start doubling up. Now I know some of you out there are thinking, oh yeah, I do that. So let's say I'm trading half a lot. Then I might go, oh, I'm going to start trading 2 lots so that I can get all that money back that I lost on the first 3 or 4 trades. Gain revenge. What does that mean? Oh yeah, you give me a hard time today, but I'm going to get you back, market. Oh yes, I'll get you back. You watch this at this next trade. 5 lots, here we go. That's totally breaking your trading plan. And that's called trying to gain revenge. It doesn't work. And losing trades affect us, no matter how unemotional we are. We're human, aren't we? But, as I've just said, if you chase your losses, determined to recover them, the consequences are likely to be disastrous. I busted an account doing this. I busted 3 accounts in my 16 years. Hey! But I have trying to revenge trade, recovering losses. I forget that this is, Forex trade is not a sprint. It's more of a marathon than a sprint. It's not a get-rich-quick scheme. Get-rich-quick scheme. However, it can certainly be a get-rich scheme. All right, I've got this saying that my students all know about. And it's, that's interesting. Example of this. You're trading along and you short the pound dollar and you're 15 pips up and you're going for 20 pips and it's almost there. And then the pound reverses and reverses 40 pips and hits your stop. Almost immediately. So, you don't do what I used to do when I first started trading, which is throw the screen out of the window or kick the computer. What you do is you say, that's interesting. If you can do that, and I say, if you can do that, that's interesting. Or, that's interesting. You're going to go a long way in this business, believe me. Now, if you've had your 3 losses, you quit for the day, but then it happens the next day and it happens the next day. If losses persist, just get back to basics. Start reading your basics again. And demo trade for a while until you're back to winning trades. It certainly works for me if I go back to demo and I go back to basics. And I improve my discipline, I'll get back to making winning trades again. Have confidence in your trading plan and have confidence in your system. Really important. So that's it for this video. That's trading gems 1 to 7 out of the 25. I'll probably do this in 2 or 3 videos. Gem number 8 next, and it's on the screen. Look for reasons not to trade. Oh yes, not to trade. Folks, this is a new channel, I know, but I'm going to be going through all 16 years of my experience in trading. Please subscribe, share it with friends. This is information that you need to know from a professional trader. Not rubbish, not marketing, and not the usual stuff. You won't find stochastic and RSI on here for a start, and many other things. I use different indicators and different ways of doing things that make money. Please like the video, subscribe, and I'll see you for gem number 8. Thank you.